Okay, everybody, we are here again, like always, on Wednesdays. And actually, it's Wednesday for me, but it's Thursday for Stephen. And this is Giovanni and Stephen. We are both physicists, in particular astrophysicists, with kind of interesting careers. We did many different things. We apply these the ideas and the concept, and in particular, way of thinking about the world that you develop studying physics to our passion for Bitcoin, because both of us discovered Bitcoin quite early uh, and immediately started to see these patterns, these regularities. Maybe not immediately recognizing a precise mathematical formula with it, but in time, actually, it revealed that Bitcoin behaves very much like a physical system. And many physical systems, uh, in fact, maybe sometime we need to do a study of how prevalent power laws are in nature and in the world. Maybe even in terms of percentage, how many laws, for example, not fundamental laws of nature have this power law form, but also other type of phenomena that not necessarily are precise laws, but more like a statistical pattern that also seems to follow a scaling behavior that is expressed by a power law. And so this is the nature of this show, where we go a little bit deeper than usual shows. So it's unique in his approach and content, where he takes some of these mathematical aspects. They don't have to be always related to the power law, but it's the idea. This is why we call it the physics of Bitcoin. The idea is that to show that Bitcoin actually is not random. Um, Today I was actually watching a video from this lady, Kathy, that interviewed uh, Saylor. She's from the Financial Times, and very well-known financial magazine or publication. And one of the things that was missing was this idea why Bitcoin will continue to go up, right? And at a certain point, scarcity was used as the key element, but it's not key at all. If we go around and start to tell people, oh, Bitcoin is going up because it's scarce, I mean, it catches this idea scarce, and with time, maybe we can explore it more. It's more about the finite, Bitcoin being finite, that is
Right.
really the fundamental characteristic. But it's not the only one, right? There are many. And so our angle is trying to show that there are these mathematical patterns, and the mathematical pattern, because also somebody commented in my on my X account, and it's something that people will need time to learn these ideas. That the power law is not just after the fact curve. It's actually predictive, and it's predictive because it's the manifestation of mechanism of why Bitcoin works in a certain way. And that is what is fundamental. And once you understand the mechanism, when you understand that Bitcoin is this network that is growing, and you can try to explain the nature of this network is people joining an alternative economical system and embracing the ideas behind it. She described it, because of course she's a skeptic, as almost like a cult, but it has relationship with a cult. Actually, one time I saw an article that showed that the growth of Christianity grew as a power law, and it's really interesting, because it's almost like a virus of the mind. It's this idea that involves people, and people join because they find something bigger than themselves in Bitcoin. So it can look like a cult, but actually it's more like a scientific revolution. It's based on logic and rationality. It's not irrational. And the data and the behavior that we show that is regular and can be explained by physics is a testament of that. And this is what the show is about. And we cover different aspects of all of these ideas in our episodes. Stephen, do you want to add something or elaborate on this?
Yes, you raised this about demonstrating that physical laws often adhere to power laws of nature. I've actually got one slide on that, so I'll cover that a little bit today, and we will
Great.
certainly continue to touch on that in future shows going forward. It
Fantastic.
gives us a grounding for this. But what we see happening in Bitcoin is a result of emergent power law behavior built around the network nature and the feedback loops of the multiple mechanisms. It's actually a meta network. And they have mutual reinforcing feedback loops. And we're in the process, Giovanni and I and others, of trying to really understand that more completely and more holistically.
Very good. Okay, do you want to go ahead and show your agenda? That is our
Yes.
tradition. Usually, Stephen goes first. It is a very well organized agenda. Okay.
All right. This is our 21st Physics of Bitcoin show. It's May 14th for many of you. I'm living in the future. I'm in May 15th already. And that's my handle both on X and Substack. And here's the agenda. I've got one slide on power laws everywhere in nature. Last week, I showed this Google by Google diagram. It's quite amazing. And, there were several power laws demonstrated on that. I'll talk a bit about energy as money. And then I have two broad topics to get into. One is the wallet balances and the wealth curve for Bitcoin and the issue of the Gini coefficient, if you've heard that terminology, but how well balanced or distributed is Bitcoin? And as we know, it's very top heavy, but I'll go into some details, in particular, including a way to adjust for the custodial holdings. I've done that. You have to do a lot of guesswork. So it reflects a lot of guesswork, but it does make some substantial difference in what the curves look like. So I'll cover that. And then I've got both updated regressions and a model. You're used to seeing people model for, power law and quantile regressions and so forth, things that are within the sort of power law domain, and then adding some modeling for the bubbles on top of that, and including even the decay of the bubbles. But I've added a third element that I don't think anyone has included before, and that is to look at two aspects of the bubbles. One is the amplitude, and the other is the volatility. And both of those are suffering declines. And so I've explicitly have a refined method for making price projections, and I'll show you that and close with that. Okay, so the first one is power laws are everywhere. There are 2 points that are being made from this slide. One is how long it can be between when something is theoretically understood in physics and then ultimately whether reality is detected. So we have black holes theorized in 1916 and gravitational waves the same year. The black holes, it took 55 years before Cygnus X1 was detected as the first one. And Giovanni himself participated in gravitational wave discoveries, and that took 100 years. I remember when Ray Weiss first started trying to do this, in the 1960s at MIT, and it took another 50 years beyond that. And then antimatter, more rapidly, it went, in a decade from when it was theorized to detected, positrons and the like. And then the Higgs boson took half a century from when it was first elucidated in 1960s theoretically and when it was detected, and it agreed quite nicely actually with the theoretical predictions. Now, in each of these cases, you can write down power law equations. And so the first one is for black holes, and it's just the relationship between the radius and the mass. And it turns out, according to general relativity, those are linear. That's a linear relationship. The radius is equal to 3 kilometers times the mass in solar masses. And it's different from ordinary matter, right? Which has a mass goes as the cube of the radius, a volume-like thing times some average density. So that's an example of a very simple power law that's just a linear relationship. The next one is the in-spiral time. If you have two black holes that are merging, how long will it take them to merge? As a function of their masses, you've got M1 and M2 in the equation, but also as a function of their separation. And it's a very steep power law. If the separation to the fourth power tells you what the in-spiral time is for those two. And so it happens very quickly at the end, and all the power generation is in the final second. Giovanni can explain that better than I. But that's an example of a steep power law, the fourth power. The next one relates to antimatter. It's the cross section for the annihilation of positrons and electrons. And this is an example where it goes inverse. It's going inversely is something like gravity itself. Newtonian gravity is inverse with the distance squared. This is an energy factor. It's basically the relativistic energy factor, how much energy there is relative to the rest mass, because it's mostly in kinetic energy. And so if that term is large, then there's there's an inverse relationship. And so that's another form of inverse power law. And the last one's an equation related to the Higgs boson and the energy of that relative to the field strength. And it's got multiple terms, three terms, but they basically go as the square of the field strength, but also as the fourth power of the field strength. So you see that we have things that are kind of direct relationships. We have others that are inverse. We have things that are, weak powers of some quantity, and we have others that are very strong, what we call a large power law index, a large slope if you put it into a log-log graph. So that's that. This is a little bit shift in topic to energy as digital money, but it relates to the idea that these discoveries can take decades or even a century. And for Bitcoin, the idea of an energy money has been around for 100 years. People have probably heard Henry Ford's name in association with there should be an energy currency, but he wasn't the first. People have probably heard Bucky Fuller's name, and I mentioned him recently in a talk. He predicted something. It was actually 1967, not 1969, when there was an interview that he did that talked about energy as what should be the basis for money. But this gentleman, Frederick Soddy, British, won a Nobel Prize in chemistry for his work in radioactive decay. He actually wrote a paper in 1921 called Wealth, Virtual Wealth, and Debt. And to summarize it, wealth originates from energy transformation, debt grows exponentially, whereas real world wealth, which could be commodities or it could be something else, it could be real estate, etc., has both growth and decay characteristics. And he called for an energy currency as an ultimate measure. And then for digital money, 1983, David Chaum is probably the first reference. But between Soddy's paper in 1921 and Bitcoin, it took 87, 88 years. And then for it to mature, to enough that people say, gee, this looks like something that's going to last. And the power law demonstrates that it's going to last and has persistence. It took a full century. Okay, now I want to get into the distribution, kind of the wealth distribution of Bitcoin. And I showed something previously like this. This is the log of number of wallets, and it spans over about 7 orders of magnitude here for how much Bitcoin is in each wallet. So you can set up these bins, and they're decade size. So it might be from 1 to 10 Bitcoin or from 0.1 to 1 Bitcoin. And so each dot here represents the midpoint, actually the geometric mean. So it's a number like 3, right? If it's the 1 to 10, it's a number like 3.1 for the kind of average, because you expect there to be more in the 1 and 2 than you do up in the 8, 9, and 10 holdings. So this is actually cumulative. It's sort of the integral of the number of wallets above a minimum bin, and it fits a parallel pretty well until you get to extremely small kind of dust balances, and the slope is minus 0.8. So it's quite top heavy unless you were to make correction for custodial ownership, because many of those wallets are exchange wallets or other large entities that are acting in a custodial fashion for many, many ultimate end users or customers. The largest 93 wallets have more than 10,000 Bitcoin, and collectively they have almost 3 million Bitcoin in aggregate. Now, I also did a time series analysis of the prior chart, which is the snapshot at the current date. But I went back in history to see how did that power law index evolve, going all the way back, to before 2010. It initially shot up to 0.8, and then it fell back to 0.6. But ever since the start of 2011, it has been rising. So the distribution has been getting smoothed out steadily with time, gradually, and it's still quite top heavy if you don't correct for custodial ownership, but it has been evolving in the more widely distributed way, if you think that's a good thing. But to really understand this better, you need to look at the cumulative wealth in each wallet, not the number of wallets. You want to add up the total wealth in that wallet. And so this is a curve like that. And the blue line is the data. And this is a log chart. So it's the log of the wealth denominated in Bitcoin versus the log of the midpoint of those same kind of decade-sized bins from 1 to 10, from 10 to 100, etc. And so the logs of that look like 0.5 and minus 0.5, etc. And the linear values are shown down below that, like 0.1, 1, 10, etc. Now, it's not a great power law. It's definitely a curve. And, at the high end, it has to saturate, right? Because it's all got to add up to 19.86 million Bitcoin. And then at the low end, it curves as well. And in part, that's because these, I'd say, custodial balances are not being well shown down there, but also because at very small balances, dust, which are not shown here, but trust me, they drop pretty rapidly. It's not kind of worth holding a very tiny amount of, a milli Bitcoin or something. We do not include lightning channels here, but that's not a huge amount. So there, you can do a power law fit roughly, and it has a slope 0.31 in these terms of log wealth versus log Bitcoin. From that, you can compute something called the Pareto alpha. If this were a power law, it would correspond to something called the Pareto distribution. It's 1 minus the slope. And so the Pareto alpha is 0.7. It has a pretty decent R squared, even though it's not that great a fit. Now, you can convert Pareto alpha into these Gini coefficients that are used in economics for example, the wealth distribution in the US, which is something like a 0.8 Gini, or in Europe, it's something like a 0.7 Gini. But in fact, if the Pareto alpha is less than 1, the Gini formula saturates. It kind of tops out at 1, the way it's constructed. And so that indicates that we've got a highly unequal or top-heavy situation here. This is the uncorrected distribution. So now I went through and with a lot of guesswork did custodial adjustments, and I went down to the level of 40,000 Bitcoin wallets and then redistributed those. And that included the 7 largest exchange wallets. Actually, there were about 10 or 11 wallets between 7 exchanges. And then the 4 largest ETFs. And then I also included Master and Mara, which is a Bitcoin miner that has decent sized holdings. And then I included 3 governments, the largest 3 governments, US, UK, and China. So then what I took is the customer counts And then I took the average per person and I just dropped it into that bin. So I dropped the whole customer count into that one bin. Now that's a gross approximation because obviously they have a distribution. So a more detailed model, you try to distribute that somehow, but it wasn't clear exactly how to do that. And so I just dropped it all into one bin. And for the nations, the 3 countries, I took the total population of the citizenry of that nation, and that amount gets assigned on a per population basis to the citizen. So for the US, it's $57 worth of Bitcoin per citizen. Is showing up in the low end of the curve here. Now, when I did all that, it kind of came up out to too many Bitcoin. It was like 20 something million. So I had to renormalize, as we do in physics, so that it would all flatten out at 19.86 billion. I basically assumed that the exchanges are lying a bit about their customer accounts, and so I scaled those back. I believe the government numbers, the China number maybe is kind of uncertain, but I think the other 2 are decently known, as well as the Master and Mara numbers. The ETFs, I also scale back because you don't know precisely how many the holders are. Those are just rough guesses. When you do all that, you get a flattened out curve. And so we show the blue line is the data adjusted. So it's the cumulative wealth, above a certain threshold in the same log plot. I've done this little bit of renormalization. And then the green line is the fit as a power law. And the index is higher by 0.1. It turns out to be a Pareto of 0.79 and a better R squared. And you can see the old curve in the inset with the white background. So you can see how it shifted and became, closer to something that looks like a power law. And in fact, the 50% wealth point, that is above what level is half the wealth? It's 100 Bitcoin in the original data, but it shifted considerably down to about 30 Bitcoin once you make these adjustments. The gray one, I said, well, what if the US were to go ahead on the strategic Bitcoin reserve and add that up to 1 million? What would that do? And so that would move the curve up like that, and it would increase the Pareto alpha by about 0.05. And then the orange line is a power law fit just above 1 Bitcoin, and it also has a higher Pareto of 0.88. So these things of distributing as custodial ownership to exchanges and ETFs and corporate treasuries that I've only partially accounted for, and governments, and we know the trends are for all of those to increase, are making the distribution flatter and increasing the Pareto alpha, but it's still below 1. So you still cannot compute a Gini. The formula of the Gini is above 1, which still indicates quite unequal. But the trend is moving that way over time. Okay, shifting topics. Now I want to introduce a different or enhanced forecasting technique that models the bubbles a little more fully. So first we start with the quantile regression, and I also show the ordinary linear least squares regression. And the ordinary least squares line is black, and the solid red line is the quantile regression median, the 0.5 level. And you can see that right now, one says 97K, the other says 87K. There's a little bit of difference there. And then what do they project a year later? And you can take the geometric mean and you get the bottom row in the table. One has a slope 5.7, the other 5.8, basically. So I base the following on the quantile regression median. These are the residuals. You see the 4 big bubbles. And then you see the, attempt to have another bubble as we go into into 2025 after year 16 tick mark. And there's the quantile equation. Now we can fit a linear fit to the peak tops, and that fits pretty well. And so people will typically, when they make the forecast, that includes a quantile regression or power law OLS, and then they'll correct for this linear decay in the tops of the peaks. Now, I've shown previously that the distribution is bimodal. So what you do is you break up in the prior one, you have the zero line, which is the soft dash line. You take the above and below, they each have half the points, data points, and define the bubble above the line and the power law core below the line, and you can approximate those by independent log normal or Gaussian style distributions, but in log space. These are residuals in log space. Once you do that, you can calculate a rolling mean for the residuals. And so I'm showing the 4-year rolling mean for those. And you see that for the core, it's essentially pretty flat. It sits between 0.1 and 0.2, moves around a bit, but doesn't change in terms of a long-term trend. And I indicate 0.7 there. Basically, it's about 30% below, on average, the quantile regression median line, which is at 0. However, for the bubble, the mean has come down by a factor of 2. It started out as 3 times above the mean of all the residuals, and then dropped to 2 times 8 years ago, and is now about 1.6 times at present. So a pretty steady trend down. Now, you can define a bubble to core price ratio. So that would be the ratio between the red line and the green line here, the green line being the core. And so that dropped from almost 5 down to between 2 and 2.5, about 2.2. And you can fit that to a reciprocal model, which is essentially 1 over age, but with a little bit of an offset so you don't have an infinity at 0. And that's the dash curve, and it fits pretty well. Now, the other thing you can do, though, is also include the volatility. So here I show the volatility for both the core and the bubble. And this is a standard deviation with a 4-year averaging window. And you can see for the core, the green line, it's about 20%. And it doesn't move around very much. But for the bubble, it started out above 100%, and it's now dropped to 40%, even as of year 15. We need a 4-year average. So it's actually more like 14.4 is the last data point that allows for a 4-year average.
I love this. It's so clean and clear.
It's so clean, and it kind of washes out the cycles, and the reciprocal fits turned out nicely. You could do a power law fit, and it would be something like inverse 0.8 or 0.85, something like that. And that would be just as acceptable, but I ended up going with the reciprocal fits here.
Yeah.
Somewhat for simplicity. So what I want to do is include this as well in the forecasting process. So I'm claiming this is a new method of forecasting, that it's rooted in the core, and it accounts for, 1, bubbles is distinct and relative to the core, which people, will typically look at. And 2, the bubble mean amplitude is decaying, which people will often, but actually typically not look at, to their detriment. You end up with too much hopium. And then thirdly, adding, and this is the new element, the bubble internal volatility. This is the volatility just within the bubble itself, not including the core and decaying. So the whole process is shown in the blue box with the white lettering. You start with the QR median. You show the Gaussians for the core and bubble regimes, and those tell you the average, mean, and standard deviation, which are these Greek letters, mu and sigma. Then you do a 4-year rolling window, and you find that actually, those Gaussians for the whole thing are not really the whole story, that it changes a lot, especially for the bubble. You then calculate the bubble to core price ratio over time. You apply a reciprocal decay to that. You do the same thing for bubble volatility and apply a reciprocal decay to that. And then you forecast your median price and you apply your core offset. So you go to the median and then you go back down to the core because you know how much the core is offset below. Then you take the bubble to core ratio and that puts you up into the middle of the bubble. And you use the reciprocal fit to project how the bubble to core ratio is changing as you go forward in time. And then you add in the volatility, and you can, pick +1, +2 sigma or other levels, and you do the reciprocal fit to that bubble volatility as well to project where those levels would be. And this is the result. So in the chart, the blue line is the median for the quantile regression. The current age is 16.3 something. So it's where that line starts. And you can see that, it's something like $87,000 now. And so you can see how that progresses. Below that is the core mean projection. You can think of that as a level of support. You can drop below that, but it's a pretty small volatility down in the core. So that's sort of a means support level. Then above that in the green line is the bubble mean and the forecast for that. And then the red dashed is one standard deviation above that, and the purple dashed line is 2 standard deviations above that bubble mean green line. And those values are tabulated for, mid 2025 at age 16.5 through the beginning of 2026 at age 17 and out to, a little over a year from now, midway through 2026. So if it says the bubble mean, the bubble has to happen, right? And we're still kind of waiting for the bubble to happen. We are above the mean, so maybe we're in that transition zone. But the bubble mean, if it happened right away, which is unlikely, might be 120. If it happens by October 1st, it would be 127,000. And then you can move above that 1 or 2 standard deviations. But the chance of getting to a 1 standard deviation is just 8% of the time. Because in a Gaussian, a log normal 2-tailed distribution, you have 68% in the middle, you have 16% in the positive tail, but this is only half the data, right? So of all the data, this is only 8% of all of the residuals. And for the 2 standard deviation, it's about a 1% chance. And what that means is you could get to 1 standard deviation looking down below at the bottom of the chart. Maybe if there's a bubble that lasts 52 weeks, which is not, unusual, then that would apply to maybe 4 weeks that you could reach that 1 standard deviation and above level.
Right, but there are people that say 1 million, Stephen. We are very bearish. $1 million in this cycle.
Impossible. Well, not, never say never, I guess, but that would be, if we just look, a standard deviation is $60,000, right? Even if it doesn't happen until a year from now. And if it happens at the end of the year, a standard deviation is $50,000. So how many standard deviations do you have to get to 1 million? Right?
Yeah.
Another
Did you calculate?
15. You'd have to have 15 standard deviations, which is, that's like the lifetime of the universe above that. Right. However, it's not purely a log normal distribution. We know that for the bubble. It does have kind of a fat tail. Yeah, so, one would have to model it with something that has some sort of like power law tail or something to get a more precise estimate. But it would still be very, very large. And actually, as you mentioned, I was just reading. I just picked up this book, Didier Sornet, Why Stock Markets Crash.
Right. Yeah, I love it.
And so I just started into that, but I just hit the page where he's talking about exactly this thing, because he looks at the 1987 stock market crash and, the chance of that and how many standard deviations it was. And then he says, well, what if it wasn't a Gaussian or log normal? What if it had this, other kind of power law tail, and shows that indeed it would still be a huge outlier. And that becomes his rationale for why bubbles are real things that break statistical models. But we know enough. We have enough experience, I say, statistically, between us to know that 1 million, it doesn't happen in this time frame. And that's where I'm going to close it.
Can you show a book, because it is actually a great book?
Yeah.
Yeah.
Why stock markets crash, and the author
A little bit higher.
Sornet, Sornette.
This is a great. Yeah, go ahead.
Princeton Press.
Yeah, it's a great book because it's written by this physicist. So we are a little bit biased towards physicists, and he's analyzing the market with with the tool of a physicist and show that it works. One is famous for this model that is called the log periodic power law. It's not directly related to the power law that we discuss. It's indirectly, because it shows, kind of scaling behaviors. Its focus is mostly on bubbles, but not just bubbles that go up, but also crashes. This is why the book is called like that. But it really helps you to think about why physics is relevant to understand markets, that, human beings are not random. Yes, there is some level of noise. What we call random often is what we don't understand. I think if we had a perfect knowledge of so many things, we could build a model where it kind of predicts almost everything. But for physicists, randomness is not knowing. Actually, is a form of knowing, because you can do distributions, you can calculate probabilities, etc. So it's actually information, and you can use it. It's a very, very beautiful book, and actually, it's not very. It is one of these books that has enough details that is not superficial, but is not meant for somebody with a physics degree. Everybody can read the book. So it's a very nice book if you can read it, and I will put it just below scale as one of the guides to understand Bitcoin power law. Okay, great. But this was very nice. So you projected these lines. Did you account also for a possible decay of a bubble or no?
Yes.
It's okay. So after the end of the year. No, I mean, like if there is a correction.
Well, I did not look at the -1 and -2 levels.
Okay. Yeah.
Yeah. I mean, yeah, we could do that.
Yeah, that would be interesting.
Yeah.
Very good. Okay. So I will go ahead and do my presentation. So the first thing I want to talk about, let's see if I can bring up this graph. What is this? Okay. So I kind of revisited the first thing. I revisited I had some time ago MicroStrategy model, and I look at the data. It's you have to be careful, because we have data for that are relevant for MicroStrategy only after to 2020, because before that, MicroStrategy was not investing in Bitcoin. And if you look at the behavior of MicroStrategy, was completely unrelated to Bitcoin, of course, right? Then in August 2020, this when MicroStrategy started to apply this strategy of buying Bitcoin and being have a treasury in Bitcoin, and the price started to match Bitcoin. But when I plotted it, because I wanted to see if it was a linear relationship, if it was some kind of other pattern, I discovered this power law. So there is a power law, basically goes where I can actually maybe write it down for you guys. It goes like this. And, there was a debate for some time. I will explain you the nature of this debate. But it goes like this, that you can calculate the price in the MicroStrategy price in dollars by knowing the price of Bitcoin. And I write in this symbol that means proportion, because there is some kind of a constant, right? Bitcoin is it's hundreds thousand. One day it will be hundreds of thousands. So right now it's 100,000, right? Close to 100,000. And MicroStrategy is only $400. But the constant takes care of that. But then it's not a linear relationship, because as Bitcoin goes up, MicroStrategy goes faster up. And so it's actually a power law. It's a power law of 1.3. Now, this doesn't have the same status of a Bitcoin power law, because um, you know the Bitcoin power law has been valid over 8 order of magnitude, if you include the first transactions ever, that actually falls on the power law. That is crazy. Um, and it's 16 years, while with MicroStrategy we have only 4 years, and the range is much smaller on the y-axis. But so far it holds. Now, there was a period of time during the beginning of this year when things went crazy, because I think people started to wake up to the leverage and the opportunity for MicroStrategy, started to speculate. And you see, this is where you actually see this behavior here, this kind of almost a straight line. And when you see a straight line, this chart is done on TradingView, and TradingView unfortunately doesn't have the log of time. Many people made this request because of the power law of Bitcoin, but they didn't respond. It would be really cool to have it, but you can take the log of the y-axis and not the log of time. But if you plot power laws, um, this one looks straight, because everything looks like a straight line if you zoom in enough. But they are not straight line; they are curved, right? Like the typical kind of rainbow shape that we are familiar for Bitcoin. But if you see a straight line, usually it's an exponential. So it follow very well the model. See, this is, in fact, I can maybe zoom out a little bit so you can see. It starts to deviate, of course, before 2020, right? It doesn't do, basically, it was flat. MicroStrategy was flat because it didn't follow the Bitcoin. And then it's really surprising, right? Because people know that they buy Bitcoin, but what is going on? It shows how interactive a market is, right? People know that it's based on Bitcoin. So I don't know. It's really interesting how people value MicroStrategy based on Bitcoin. It's not a direct mechanism, right? It's how the market works. It is really interesting. And so what you see here, the blue line, it's the price itself, the real price, and in red is basically this formula that I show you here. If I take, I first fitted the power law, Bitcoin versus MicroStrategy, I derive the parameters, the constant and the power. And then you see for a little while, it was working very well. And sometimes MicroStrategy is undervalued. That means it's when it's below the red curve. So remember, the red curve is a model. Sometimes it's overvalued when it's above the red curve. And then we had this crazy time when it seemed not to follow anymore the pattern, but I fixed it by basically correcting this behavior, adjusting this. All what I did really is to multiply by a constant uh, at a particular point, and then it restore the behavior, because you can see from here on it started to go again along the power law. It follows very closely the formula. So it's kind of interesting. We will keep an eye, right? But there is this. I will try
Giovanni,
to. Yeah, go ahead.
could I make a comment? I have
Sure. Yeah, absolutely.
interesting comment. For people that have followed Jeffrey West's work in scale, or some of the times when we've talked about that, uh, you would know that cities have power law scaling, but companies do not. So a couple of comments here. One is that, of course, Bitcoin has power law scaling, and Michael Saylor has transformed MicroStrategy from something that scales like a company and was floundering to something that scales like a city. And Bitcoin allowed him to make that transformation. And that means that his company, like Bitcoin, has very high persistence likelihood.
Yeah.
The second comment is the power law exponent that you found, 1.3, is about equal to that for cities. That's the power law scaling of
Oh, very
cities.
interesting. Yeah,
Their utility cost is 0.85. It scales as 0.85. They have efficiencies, economies of scale in their infrastructure for their utility networks, their road transportation networks, and so forth. But their output, their GDP, the number of their gross domestic product for a city, and their number of patents and so forth scales around 1.15. And when you take the ratio of that, it scales as 1.3. I would submit to you that MicroStrategy has built a Bitcoin citadel or city on top of the infrastructure
Yeah.
of Bitcoin itself, the Bitcoin
Yeah.
network.
That you mentioned this idea of a city all the time, but and this is why I would like him to embrace sooner or later this language of a power law, because it's the math behind the city's economy, and this will convince a lot of people that there is so much more, and it's just not just some speculative scheme. It's really building something, and the cities are so fundamental because it's civilization started with cities, when people went to cities and leveraged the power of collaboration, working together, and basically this power. In fact, I was surprised because I started to look for historical data, like Roman cities, and there is, and actually people show that even these ancient cities follow power laws. It is incredible. It's not just modern cities, even ancient ones. So it's really interesting. So thank you for this remark. And I can make another remark. So when there are times where people, because of greed or because of speculation or because of FOMO, push away that behavior. So it's actually, this is a feature, people like exponential. They want, oh, let's go crazy. Let's, because I remember like if it was now when this was happening. And in fact, I was making videos saying, guys, something needs to give up, because we cannot continue with this exponential behavior. We cannot go forever. And, they were, and some of these are kids or teenagers. They want to become rich. And, there is this community of MicroStrategy investors. They were really rambunctious, and they wanted to, they thought they were going to own the world. And I told them, this is not going to continue forever. And it's good that, again, MicroStrategy, because it's based on Bitcoin, it corrected this, right? It's basically, they had their own bubble, right? Like Bitcoin has bubble, and Bitcoin has taught us, yeah, you can have bubbles, but every time we had a bubble, we corrected and we went back to the power law. And MicroStrategy is doing this again, because it's a power law of a power law. And so it's really cool that after all this energy was it was almost like an escape valve, right? All this energy, enthusiasm, etc., escaped. We went back to the more sustainable and really powerful behavior, because I rather have something that grows steadily with a very precise law over 10 years, 20 years, 100 years, and something that goes up very quickly and then inevitably decays, right? Or collapses like exponentials do. So it's really cool that actually what these analogies that you made, that MicroStrategy maybe is the first company that actually is behaving like a city versus like other companies do. And this gives stability and strength, right? So all the things that people say about MicroStrategy that it will collapse, and it's actually the opposite. And but if you follow us, we give you these insights. Other people use things like scarcity and other ideas that the not average person don't understand. And they have a point when they say, hey, my teeth are also scarce. You can make fun of them, but if you really want to reach them and trying to make them become a Bitcoiner, these are valid. We know where they go wrong, right? But at the same time, it's not that stupid of a comment, right? Because actually we are pointing out the wrong things. We should point
I
out to other things.
I saw today that the famed short seller Jim Chanos has a big position that is long Bitcoin and short MicroStrategy.
Hmm.
And
It doesn't make a lot of
if
sense, but
if he
okay.
understood that this power law, he might
Right.
save a lot of money.
Yeah,
He's
exactly.
he's doing something that is against the math and against what we believe that is the reality here.
Yes, exactly. Anyway, so this is part of what. So we will continue to monitor it and see. I made some projections, mostly based on the power law core or the power law nominal value. And so, what to expect if this power law continues, both for Bitcoin and for MicroStrategy. Now, we could add standard deviations like Stephen has done. So it's something that I can work out, like what is the best case scenario. But this is kind of a reference point of what to expect. Okay. I have maybe few more minutes. I want to present something else. And I'm going to discuss instead these. Okay. So actually, first I want to show these because maybe in a certain point, me and Stephen can talk about. Stephen already posted a bunch of posts on his X, but and we are not the first people. Other people mention Nash, so this is it's the movie Beautiful Mind. It was about the life of John Nash. He won a Nobel Prize in economy for his ideas in game theory applied to finance. And by the way, when people use game theory, many times they use it in the context of Bitcoin, but they refer about if the US starts to create a reserve, then a strategic reserve in other countries, and they use very loosely this word game theory, and I cringe every single time because it's not the correct use of the word game theory. Game theory is such a branch of mathematics that it means something very precise, and using it like this in a loose way, it's kind of diminish the value. So I don't think actually that could be interesting to write a game theory of Bitcoin, but it's not what people talk about. But John Nash discussed his ideas on money, and it's very fascinating because in many ways he predict it, kind of is very parallel to our concept of Bitcoin, and it predates it. In fact, some people claim that he is Satoshi, but he's not Satoshi, but very likely. But that's very interesting thinker in that, in that area of thinking about something that is independent, is decentralized, and so on. So we should explore it because it's very relevant to many things we talk about. This one of the, we had a discussions recently where we were exploring this. But anyway, so another concept that I'm exploring is more about kind of a research plan than results that I have right now. I want to explore more this idea of scale-free networks, because when we say that power laws are natural for networks, it's not completely trivial. Yes, they can derive from network property, but under one very precise condition. Uh, that is something that happens often. This is why many real networks do have power law properties. But historically, what happens is that so network. Let me define first of all, because we mention networks all the time. What do we mean for network? So network, it's a way of understanding. It's a kind of a framework to understand complex systems, and uh, they are characterized by basically individual entities, individual centers. And these centers, just to give you some example that will bring into context the idea of a network, could be, for example, the cells of a body. Cells of a body are, you can go and zoom in on a cell, and it's on almost its own little world, right? There are many things happening inside the cell. In fact, the cell itself can be understood as a network. But you can consider, right, this always starts from some simplification. You can consider every cell what is called a node. So it's a central part of a kind of, initially you can think it as a separate unit of this system that is also interacting. All these units are isolated but also interacting with other units. They do a lot of things by themselves, then they transfer or interact with other similar units through some mean. Okay, in the case of cells, there is no, unless you are a neuron. Neurons actually have a physical connection between each other. So it's actually, the brain itself is even a better network, right? Because we have these axons that actually connect the neurons physically, or in a more direct way. The cells of the body are also a network because we have a vascular system, right? They transfer nutrients and signals, chemical signals. They communicate through the medium of the body, right? Through the blood, through the fluid that are in the body, and so on, through um, different type of chemicals, and metabolism, etc. So, and in a social network, we are, this will be the people, right? Every individual, and they communicate through the internet, through the different social platforms, etc. Right? There is a transfer of information, and so the individual components are called nodes. That is the technical term, and the connections, that is the other fundamental component of a network. What makes a network can be different ways of communication, like physical, or through whatever. Usually physical, but can be more direct and less direct in some kind of information. And then the units take in account the communications of the information from the other nodes, and then they make some decisions, or they do something, like the cells, they produce certain chemicals or certain proteins or whatever, based on communications with the other entities. And this is what makes a network. And there are, people have written entire books, and there is an entire science that study the properties of this network, how they grow, how they develop, how the information is communicated, what is called the topology, so how they are structured, many connections there are, how, like if there are a lot of connections, if maybe there are groupings where there is one group that is strongly connected, and then this group communicate maybe with a single connections. We have all kind of terminology, small world, large world, and mathematicians and physicists studied these systems. Now, one of the first, there was a mathematician called Erdos that wrote a lot of papers on these networks from almost a pure mathematical point of view. And one of the proposal was, well, basically they grow in a random fashion. That when you have a network, you will have connections between the other nodes, but they are going to follow some kind of random distribution, kind of like what Stephen was mentioning before, this Gaussian distribution, right? Gaussian distribution, for the non-mathematician among us, is the famous bell curve. You see here the bell curve. And so you will have, every node will have a certain number of edges. So another name for technical name for the connections is edges, because it's like a hedge of some kind of um, geometrical figure. So you have the vertices and the edges of a geometrical figure. And so, as the system develops, you're going to have a certain average number, and then you can predict how many connections the other nodes will have, because if you know the characteristics of a distribution, for example, the standard deviation, etc., you can say, okay, there will be a certain numbers that have as you go farther and farther away from the mean, you're going to have, in this case, more connections, in this case, less connection, but you follow this predictable pattern. So this is one of the proposals where people had it, and there are a lot of articles, a lot of studies based on this, what are called random networks. It turns out that real networks in real life are very rarely random. It's almost never like this. If you take real networks, actually they look more like this, where there is some kind of important node, and this node is very well connected. It's kind of actually related to what Stephen was discussing tonight about these Pareto distributions. A lot of these Pareto distribution develop because there are some nodes, some members of these networks that are more active, or for whatever reasons, maybe because of their, like if you're talking about people that got in early in Bitcoin network, right? They are going to be richer because they came up early on in the network. They bought a bunch of Bitcoin at very little price, and then it's difficult to nudge them out of that position. And you will have these distributions that are, they have a lot of wealth in the hands of few. But and most of us, I think that is unfair that happens. Of course, if we were one of this person, you will think it's very fair. And in Bitcoin, to be honest, I think it's actually very fair, because these were people that took the risk. They were early adopters. Bitcoin will not have existed if it was not for them. So it's actually, among the unfair distribution of wealth, probably this is one of the most justified. That is another thing that is not often discussed. These were really, truly adopters, right? A lot of the wealth right now in the world in cash is due to inheritance. It's not due to people really taking risk and being pioneers. With Bitcoin, that is the case, right? So that is one thing that should be considered. But actually, is an important feature, because if you have and so there are two aspects. One is how many coins, so people have, so wealth, but also how certain nodes, because like again, Stephen, I'm almost in agreement with everything Stephen says. He mentioned that Bitcoin is a meta network, right? So it is a network of networks. There are many different type of networks, and one of the networks is a social network. Right? You guys are following us tonight and listening us talking about these things, but it happens at a social level, right? Where we have X, we have many different social networks. We discuss Bitcoin, and you have people that have more connections with others. These are the influencers, right? And then there will be another influencer over there that is connected by this influencer by one single connections. So when you are, and this is called preferential attachment, and or sometimes they say the rich, it's becoming richer, right? So if you get a lot of people on a certain point, even this sometimes is even amplified by the algorithms that some of these social platforms use, that person will get even more connections, and they grow while the average person doesn't have so many connections. And you will think that is a bug, right? Because it would be nice if everybody was connected to everybody else. But it's not actually actually will be a bad thing. Um, and because what happens, this behavior gives more, let's say, uh, resilience to the system, because let's say that there is a failure of many of these nodes, general nodes. Well, it's not a problem because most of the nodes are actually connected to one thing, to few people. That can be also a point of attack, right? If you only have few of these guys, but if you have enough, actually, uh, you know, to make it the network work, all what you need is these nodes to be operating. So for some reason, nature prefers it, right? Because this is what happens. Like, and you get the other efficiencies because, for example, in the organism, the fact that we have organs, right? That is exactly what that represents. There are these central parts where a lot of cells are all very, very well connected. They are specialized with a particular task, and then they are connected to everything else. And you can get economies of scale in that case, like for example with metabolism, etc. You get a lot of good results by the system being organized in this way with this preferential attachment. And this graph here is now obvious because it shows like a linear form of a graph. You see here is the number of nodes, here the number of edges, and then it doesn't follow this Gaussian distribution. It follows here the graph on the right. It follows this curve, and guess what? What that curve is? It's a power law. If I plotted the log of nodes versus the log of edges, it will look like a power law. And so power laws come, and one of the main scholars that studied this idea, his name is Barabasi, and he's a Hungarian physicist, and he's one of the fathers of this network science, and he was able to show both experimentally but also theoretically that power laws in networks derive from this topology, this organization of a network, having few centers that are well connected, and of course they scale, right? And remember here is the scaling behavior of some what is this showing is there are a lot of nodes that are very few connections, and then as you go towards nodes with a lot of edges, they are becoming smaller and smaller, right? But with a power law behavior. So this is something that I want to study better, and using addresses because it's our best proxy for users, and show that actually this is the case for Bitcoin. I'm pretty sure because this is how we get the power laws in addresses, price, hash rate, but will be nice to actually have more evidence for that to show that there is a one-to-one correspondence. So this is kind of an explanation of my research plan for the next few weeks where I want to go. I already kind of explained that a lot because I did some derivations of theoretical derivation that I show in previous episodes, that you actually get these power laws in Bitcoins, like for example with the addresses, with very, very simple assumptions that actually show. I think the other thing is to show that this is related to preferential attachment. But for example, you get the power law in addresses by simply say, hey, the addresses grow proportionally to the addresses. It is a pretty good assumption, right? More addresses you have, more you're going to get, because addresses represents users. These users, orange pill, more users. So it's expected that the addresses will grow with the number of addresses, right? That again, we use as a proxy for a user. And all what you need to get a power law is that there is some kind of a diffusion. This is also an idea that Stephen proposed. There is some kind of a diffusion process where the efficiency of these expansions of users goes down in time. Yes, on one end we are growing because we have more and more people, but how efficient this process is becoming slower because of this one over time effect. Then you're going to get the power law. And same thing with the Metcalfe law that is basically saying how the price reacts to this activity in the network or this growth of users. Again, you do the same assumption, all very simple, powerful assumption. You say all the value, it's proportional to the activity in the network. It seems reasonable. All what you have to do to get the power law is to say, well, that activity is one over the users in this case, not one over time, or some constant over the users, and proportional to the activity. So the change in activity is proportional to the activity, but also inversely proportional to the number of users. If you do that, you get another power law. So, and I want to show that this is equivalent to preferential attachment, that this is a consequence of preferential attachment. So I'm going to work on that and I will show you my results. One more thing, something that I want to work also, but I'm still stuck, and maybe Stephen, you can give me some clues. How the finiteness of a total number of bitcoins affect all this? I'm not sure yet how to include that component. Every time I tried, I get stuck. How can we include the fact that Bitcoin actually has a finite number of Bitcoins in our modeling, theoretical modeling of Bitcoin? Do you have any idea?
No, only a hint. You have to keep renormalizing, which is
there is a
what I
redistribution,
discovered by
right?
this wealth distribution, which is really that same process of a bunch of transactions, right? And constant redistribution of wealth results in that curve. And I found, I had to go through this renormalization process. So there may be something there.
Yes, exactly. But it is not going to be trivial to include it, but it has to be a component. But this, every time I tried to include it directly, I was getting stuck. But maybe I need to think better about these issues. But this is where I want to go next. Because I think it would be interesting to show that it's important to have actually a finite system, for Bitcoin to work the way it does.
I think you need to have a reservoir.
A
reservoir
that I like it.
Represents a market, right?
Yeah, you have a reservoir
with an auction going on, and that is also getting incremental supply added to it from miners.
Right. Yeah. Well, it's almost nowhere, right? Because it's becoming constant.
But that's small now.
Yeah. Anyway, so these are the lines of research that I want to explore next. Okay. Let's see if we have any questions. So there are some nice compliments. It's their favorite day of the week. That is great. Okay. So there is this question. Guys, what do you think of the rising kidnap of ransom attacks on crypto owners? I don't know. It's not really related to things that we discuss, but
I have a comment.
Yeah.
And a question. If you own more than 10,000 Bitcoin, you're in that top bin, please raise your hand. but beyond that, I would say, well, if you get to be a billionaire, you better have personal security, right? All the time. In any case, whether it's in Bitcoin or whether it's in fiat or something else, you better have personal security for your family and yourself. Stay away from Paris, I guess.
Right. Yeah. I mean, I understand it, and I know this is why a lot of people are anonymous in the community, but that can happen up to a point, right? That people can figure out anyway stuff. And if you want to contribute to the community, being an influencer or being, an educator, it's almost impossible, right? So at a certain point, you you probably want to have security. But it's also FUD, right? Where I will not base these information to make actions, about like not owning Bitcoin, for example, right? It's possible also. It is one of these things that people use to create doubts about being a Bitcoin users, etc. So, yeah.
Yeah, it's an argument for custody, but that's not a full solution. So, yeah.
So, and then we have a question like this: is Bitcoin a scam? What do you think?
Well, if a Ponzi scheme has to have a marketing department and has to have the ability to print additional coupons, right? Or shares or whatever. And Bitcoin has none of that.
Yeah.
So Bitcoin is encapsulated energy. It's encapsulated energy that has to go through a very rigorous process, and it's impossible to unwind that process. You might mount a 51% attack, and then you can only do some things going forward, but you can't unwind there. So there are a lot of adjacent scams. One could argue that everything that's not Bitcoin that's in the crypto world is to some extent a scam. Most of them they're all counterfeits in some sense or the other. They're all trying to copy the original.
Yeah, and in fact, I will say that Bitcoin is the anti-scam. It's the opposite of a
Absolutely.
scam, and one could actually make even mathematical arguments for that. Because first of all, this idea that is growing with a power law, right? Usually, scams are very exponential. That is another thing that is why I don't like exponential in general, because if you have a system where you need to bring other people to make the scam going, right? uh, Imagine every person brings two people, that leads, when you have some constant rate of growth like that, that leads to an exponential. And Bitcoin is not like that. Actually has these, like I just discussed, it has this kind of slowing down mechanism that guarantee the scaling behavior. And that usually means that actually, as a system matures, there are these control mechanisms that there are, people are actually, one of the reasons, for example, why with 1/t probably is there is because it's a process. People don't jump in on Bitcoin, right? It takes time to process the information. This is why it's so difficult to orange pill people. People need to change their way of thinking. It takes time. Like some people say, "Oh, I didn't get Bitcoin immediately," right? They need to spend time. They need to study Bitcoin. It is in average, of course, right? You're going to have a range of behavior, etc. But if you think about yourself, it took time for you to understand Bitcoin. You need to study, you need to understand it. And this is why so many people don't join Bitcoin yet, because it's a process that takes time. And this is why that 1/t, it as it grows, it's more difficult to bring in, from an efficiency point of view, more and more people. That is actually the opposite, because usually scams became, in fact, if they are not exponential, they are even faster than exponential. They explode and then they collapse. So Bitcoin, you can just actually make a mathematical case that is not a scam. I still working on this article on why Bitcoin is valuable, and one could write an entire book just on that. What are all? It's really like almost a triangle of proposition. The fact it's a ledger, the fact it's a network. The fact that it has this mathematical part. It's all connected, and you can make a very powerful case that it's really, we are building these cities in the digital world, right? That is where we are actually moving our knowledge, our understanding, our economy, our value. And so when one of the things I noticed that there are a lot of these important influencers like Saylor that have very powerful intuition about Bitcoin, like him using this metaphor of a city. But then what the power law does, it gives the mathematical support for this very powerful intuition. It's really cool. So yeah, Bitcoin is the anti-scam. It's the opposite of a scam. How the universe work? It's a big
I,
question, right?
I don't think we have time for that one. Let's skip to his second question.
Yes.
The second question. Finite amount of protons, matter cannot be created or destroyed. Your statement is false. Matter can be created and destroyed. Your life depends on it. It's what happens in the center of the sun. There's conversion of protons and neutrons into photons and neutrinos, and that's why you're alive. But to first order, that is small. The number of protons in the universe is changing very, very slowly. And protons have infinite lifetimes, and all we're doing is changing the isotopes when you have thermonuclear fusion, and then if it's a heavy enough star, you can have fission, and so things move around. But there is conversion of matter to energy that's going on, and of course, I talked at the beginning about antimatter meeting matter, and that's mutual annihilation of both. And of course, we convert matter to other forms of matter and radiation all the time in our accelerators. So to first order, the average density per co-moving volume, which is expanding, doesn't change. But to second order, the processes within stars do change matter into radiation.
So one analogy, in fact, it kind of partially answer also how the universe work. With this, one should write a book about that, but people have done it. But anyway, it's this concept, because in fact, eventually, when I discuss where Bitcoin gets its value, I will mention this concept. The concept is, I don't know if many people are familiar with this, is that the total energy of a universe is zero. And that is surprising. And how can it be zero? First of all, because it can be zero because there is positive energy and negative energy. The negative energy is the gravitational potential energy, and the positive energy is the kinetic energy of the stars, planets that are moving in the universe. If you sum it, it's as close as we can tell, zero. That it's a hint that probably the universe came from nothing, but that is another story. So how can you create? So that, I think, is a very good parallel with having the ability to represent all the things that can happen in the universe, or the financial universe, with a finite amount of coins. Because what happens is, every time you have a positive coin, so I send you a coin, right? And you have this coin and a fractional coin, whatever, in your wallet. A negative coin is being created in my wallet, right? It's being subtracted from my coin. And you can create all the possible activity just by redistributing. That is what Stephen was discussing today, because this, in the end, what happens if you have a finite system, you only redistribute things around, but you can do everything with that. And this is exactly the secret of a universe, that the total energy is zero, but by redistributing this energy in different places, you get all the activity, all the dynamics, all the creative things, life, etc., that we observe in the universe. With zero, that is a finite amount. It doesn't even matter that is zero. It could have been 15. What is important, that is constant. That is constant, the total amount of energy, negative and positive. But with having something constant, then you can redistribute and do everything. That is really the closest analogy that I can think between some fundamental property of the universe and Bitcoin itself. Do you agree, Steve, with this
Sure.
analogy?
Yeah. No, Alan Guth, who's the father of inflation, also agrees. There's an
Yes.
interesting video of him talking
Exactly.
about that. Yeah.
Anyway, let's see. I'm interested again in the chances of price going above 219 by the end of 25. being less than 1.9%.
Mhm.
What do you think?
Yeah, let me just go back to that. Um,
You want to share your
he,
screen?
and he actually then shifted it to 1.2%. So he sort of corrected himself. Yeah, let me put that slide up. Okay. Make that full screen. Okay, so the end of 2025 is the middle row of the table. So if we have a bubble that kind of looks like the prior bubbles, but has a decay in both amplitude and in volatility, the mean of that bubble would be around 136,000. The one standard deviation, which would be 8% of all the data points, would be around 185,000, and the two standard deviation, which would be 1% roughly of all the data points, say in a 4-year window, would be 234,000. But really, it has to happen within the bubble window, which is about 1 year. So maybe it's half a week. So the 219 number corresponds to age 16.75, and that would be October 3rd. Call it October 1st. So if we get a bubble between now and the end of September, and it would have to start sooner and develop well, then getting to 173 is not that hard. It's 1 sigma, but getting to 219, 220 would be, maybe near a top. Doesn't mean it doesn't go above that. It doesn't mean it reaches it either, but it's a pretty infrequent. But that's actually, beginning of October, not at the end of the year, and higher if it's at the end of the year.
And Stephen said that this is a little bit conservative because we do have a fat tail in this distribution. So during bubble, we do tend to go to a little bit more extreme values when it should be normal. Like if it was just a Gaussian distribution. But these are extreme events, right? These are extreme events. So yeah, I will say that I think I will be surprised if we go 150, 180 by the end of year. It seems that right now the Bitcoin likes to be much more stable than in the past, and so that is still out. Something that we need more data, but it looks like that, right? One of the things maybe I can show next time, but Stephen also showed these. And maybe we can give an update every time. I have an indicator that calculates R square for the power law, and that R square is going up in time. Is in fact recently it went up. It went higher simply because we are supposed to go into this bubble behavior, and we are not there yet. We started when we had a correction, kind of average out whatever bubble behavior we had, and now we seem to go back to that behavior, but not quite yet. So, and I'm okay, right? I'm actually, to be honest, I will be okay with a lot of local volatility. So if you are interested in, other things to amplify your own in Bitcoin, like, if you want to learn how to do options, for example, maybe you can learn how to do cover options, like I will never use a large chunk of your holdings, because you should be long-term holders with Bitcoin, but you can use a small percentage, 5%, 10%. This is not financial advisor, but I do that. I take a small little percentage, and I want to learn about this financial concept like options, and then I try to do things to get more Bitcoins. And so if we had a system where that added this long-term trajectory plus some volatility that you can use, it will be the best of both worlds, but yeah, let's see. Anyway, guys, I think this kind of covered it, and we had fun like always, and we plan to be here next week again. Thank you so much to
Thanks, everybody.
follow us. Bye, guys. Bye. Good night, everybody.